Tom, did you get your money?
No.
Well, I did. Old man Potter will pay 50 cents on the dollar for every share you got.
50 cents on the dollar?
Yes, cash.
Well, what do you say?
No, Tom, you have to stick to your original agreement. Now, give us 60 days on this
Okay,
thing.
Randall.
Are you going to Potter's?
Better to get half than nothing.
That's what I need.
Tom! Randall, wait. Now, wait. Now, listen. Now, listen to me. I beg of you not to do this thing. If Potter gets a hold of this building and alone, there'll never be another decent house built in this town. He's already got charge of the bank, he's got the bus line, he got the department stores, and now he's after us. Why? Well, it's very simple, because we're cutting in on his business, that's why. And because he wants to keep you living in his slums and paying the kind of rent he decides. Joe, you had one of those Potter houses, didn't you? Well, have you forgotten? Have you forgotten what he charged you for that broken-down shack? Here, Ed, you remember last year when things weren't going so well and you couldn't make your payments? Well, you didn't lose your house, did you? You think Potter would have let you keep it? Can't you understand what's happening here? Don't you see what's happening? Potter isn't selling, Potter's buying. And why? Because we're panicky and he's not, that's why. He's picking up some bargain. Now, we can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money.
How am I going to live until the bank opens?
I got doctor bills to pay.
I need cash.
I can't keep my kids on faith. I've got to have...
How much do you need?
Hey! I got $2,000. Here's $2,000. This will tide us over to the bank reopens. All right, Tom, how much do you need?
$242.
No, Tom, just enough to tide you over until the bank reopens.
I'll take $242.
There you are.
That'll close my account.
Your account's still here. That's a loan. Okay. All right, Ed.
Well, I got $300 here, George.
All right, now, Ed, what'll it take until the bank opens? What do you need?
Well, I suppose $20.
$20. Now you're talking. Thanks, Ed. That's fine. All right, now, Miss Thompson, how much do you want?
But it's your own money,
Now,
George.
never mind about that. How much do you want now?
I can get along with 20, all right.
$20, fine.
And I'll sign the paper.
You don't have to sign anything. I know you pay when you can. That's okay. All right, Miss Davis.
Could I have $17.50?
Bless your heart. Of course you can have it. You got 50 cents.
You're listening to Let Me Speak to a Manager with Frank Cava and Ian Mathews.
What a crock of shit.
Yeah, that was Hot Mike, Sam.
You can't say God on the air.
Don't worry, nobody's listening anyway.
Do it live! I'll write it and we'll do it live!
Frankie!
Ian, you bank running son of a bitch.
Oh boy, man, we are on the brink of another crisis. I saw a hilarious meme on the internet the other day, just said something like it had like some guy just chewing on chips on a couch, watching with like a grin on his face, saying like, this is millennials seeing the 27th world-ending event in our lifetimes while we watch from a couch. Every 6 months, something new is popping up. We're going to talk today about what's going on in the banking sector. I think we both agreed when this happened. We had a few people say, you guys need to do an emergency episode on SVB. And I think we wanted to see everything blow out a little, then try to go hijack the news cycle and jump in before you get a little bit more facts and a little bit more information. So I'm going to start this episode for our loyal listeners. If you are new to us and you don't know, we are just a couple of jackass guys that run a few businesses and invest our own money. We are not banking experts. We are not licensed to give any advice. We do not know what the future will hold. We can talk somewhat educated about the past economic situations that we've been in, but please do not take anything we say as investing advice. Get your own information from wherever the hell you get it. I wouldn't listen to anyone's advice really, because I don't think anyone knows what the hell they're talking about when it comes to this kind of stuff. Frank, do you have any other disclosures you'd like to give before we start?
No, that was wonderful.
Okay. Frankie, I'm going to start with just a quote. We believe the effects of the troubles in the banking sector on the broader market will likely be limited, and we do not expect significant spillovers to the rest of the economy or to the financial system. Sounds like anyone could have said that in the past week, from our government, from the SEC. That could have come from one of our many Fed board chairmen. That quote, though, was actually said by then Fed Chairman Ben Bernanke in a speech in May of 2007, just about 15 months before the entire world's financial economy came boiling down. And at the time, Ben Bernanke, who replaced Greenspan, was thought of as sort of this, prescient, he's always ahead of it. He was a student of the Great Depression. He was kind of the world's leading expert on crises. And at the time, he was saying, we don't see any kind of a spillover, any kind of problems, anything happening. And right now, Frank, you're hearing everyone saying the same thing. Janet Yellen was just in front of Congress saying, we think that it's largely contained. So I am always incredibly skeptical when lots of government officials start telling me nothing to see here, everything should be fine.
So I'll start with a quote as well. Mine is from less known sources, The Economist.
Sources unknown? Is it like where where the missing link was from? Parts unknown?
And Jimmy Superfly Snuka. Banking is a confidence trick. Financial history is littered with runs for the straightforward reason that no bank can survive if enough depositors want to be repaid at the same time. The trick, therefore, is to ensure that customers never have cause to whisk away their cash. It is one that bosses at Silicon Valley Bank, formerly America's 16th largest lender, failed to perform at a crucial moment. And I think the cold open to this, Ian, as we just talked about, is our favorite boy, George Bailey. You're top 10 movie for, I think, both of us, if not our favorites. And it's just that simple. When people get shook and there's confidence that runs, these are the things that happen. And I think what we're going to talk about today is how do we get here? What happened? What caused it? There's a lot of things that caused it as far as I'm concerned. And I believe the medicine is just starting to be served. And these are things that we've been talking about here for 6 to 12 months.
In George Bailey's time, which is 100 years ago, there's a famous scene where everyone runs into the bank and they're saying, I want my money out right now. And George is trying to explain to people that's not how a bank works. My money is in your house and it's in the house that we helped you build. It's in mortgages. At the time you didn't sell it. You lent it out in different ways. So, had we just held on to that money, none of you would have got a mortgage to ever build a house in Bailey Park. He's trying to explain you can't all ask for your money back because I don't have it. So what can I give you to just get you through? And he's trying to calm everyone down in that famous scene. And he ends up using his money for his honeymoon to keep the bank solvent just till the end of the day. And I think to start, we just had a run on several banks and it's very scary. One of them is the second largest run on any bank in history. The largest run on a bank is Washington Mutual, happened in 2008, an actually chartered bank. And SVB was the second largest.
Let's say that real quick. So what Ian was just saying, it was Washington Mutual's first, SVB was second, but there was other things that also collapsed last time, but those weren't chartered banks, those were investment banks. So there's a distinction to be made there, right? It was Bear Stearns in March of 2008, and then it was Lehman Brothers in October of 2008. But there's a difference between those kind of banks, Ian. Talk about the differences.
Well, they're regulated different. They're regulated different and they have different purposes. So when someone invests in an investment bank, you're taking on a certain amount of risk. You know that when you put your money in there, you're looking for more yield, you're looking for a higher return. You know that that's inherently risky. When people invest in a bank and it's chartered bank, a federally chartered bank, there are capital requirements that are different. The amount of cash you have to keep on hand to be able to pay depositors out. If something goes wrong, you're not allowed to take the kind of risk you could. Now, a lot of that changed because a lot of those same banks that Frank's talking about went and tried to get chartered as banks afterward. And we'll talk a little bit about how regulations worked. But, a typical depositor in a bank at, let's say, Wells Fargo or a U.S. bank or, a local bank, they don't think they're depositing their money and you're going and running and placing crazy bets on tech stocks, which is not even really what happened here. But if you think about how banking works, Frank, it's similar to I was actually trying to explain this to my son because it was on, and he was saying, how does a bank fail? How does all this happen? It's a little bit like if you run a gym, you have everyone's money, they pay you every month, and technically they could all show up at 8 a.m. on Tuesday, everyone that is part of the gym. And if they did, it would be complete chaos and it would break. Nothing would work. There
wouldn't be any room for anybody.
There wouldn't be any room. It wouldn't fit. You wouldn't be able to get them all in. Everyone would be waiting for treadmills. It'd be a disaster. But a gym knows that realistically, people are going to come throughout the week. A lot of people will never come at all. They play percentages when they go ahead and take people's money.
So let me interject this, because I have an uncle that owns 16 Planet Fitness gyms. Do you know what percentage of people that sign up for a membership come at least once a month to a Planet Fitness gym?
I guarantee you it's one of the lowest out there, because they're not real big. They're not trying to find the physical enthusiasts. So I would say 20% of people show up.
3.
So how is the business model? Why do those people not quit? Why do they not?
It's $9.99 a month, and it's just so cheap they don't quit. It's more hassle to call and quit. But that's the point. They book the gym out at like 25-1 on members to occupancy, because they know there's a factor of how many people will show up. Now, Gold's Gym probably doesn't go quite that aggressive, but if you've ever seen on January 1st, Gold's Gym looks like someone just kicked over an ant's nest, because the most people show up to go hit their not in the first, they're all hungover. The second, their New Year's resolution starts, and it's packed. But that's the reason why, because there's a huge spike in people that come. But I think the gym is a really good kind of analogy on, if everybody shows up at once, you can't do bench. Just like if everybody asks for their money at once, there's no money left in the bank.
Yeah, I think that's right. And so, banks are, charter banks have to keep a certain amount of capital on hand, and they're allowed to lend out. They're allowed to do loans. They're allowed to purchase certain securities, but it's all regulated. And the larger banks, the ones that were deemed during Dodd-Frank in 2008, we'll get into this, they were deemed systemically too big to fail. Right. They have different charters than some of the smaller regional ones, and SVB was considered a regional bank, even though it got to $200 billion under assets. So, when a run on a bank happens, people start thinking that the bank is going under and they're going to lose their money. And so everyone all at once asks for their money back. And so in the past couple of weeks, 3 US banks have just collapsed. SVB was the biggest, but Signature was another bank, and they were all kind of similar situations. And First Republic was another. Credit Suisse had to get bailed out. And so these dominoes start falling, which is always what happens during every panic, is you just go from one kind of emergency to the next as people try to survive the one, then they start sniffing around for who's next. But we've, Frank's talked about this, and you could talk about a little now, Frank, of what led to SVB, but a lot of this had to do with monetary policy.
For sure. So let me just contrast this quickly, right? So in the financial crisis of 2007 to 2009, it was the result of reckless lending and a housing bust. Those were the things that caused the Great Recession, right? Post-crisis regulation, therefore, sought to limit the credit risk and ensure that banks hold assets that will reliably have buyers. When I say what's going to reliably have a buyer, Ian, what is the thing that comes up first in your mind? Always.
Reliably have a buyer?
Yeah.
I don't know what comes up. What
U.S. Treasury. The U.S. Treasury is almost.
Oh, what's the safest bet?
Yes.
Yeah, Treasury. U.S. Treasury is considered the safest bet on the planet.
So by contrast, there are roughly 4,700 small and mid-sized banks. These are the ones that weren't deemed too big to fail. There's 4,700 of them, and I use 3 of them regularly, which we'll talk about in a second. With total assets of $10.5 trillion. They've got to keep the things going so people don't have runs on them, right? So these are the different things that kind of come about, but there's the regulation that came about is that after 2007, 2009, they wanted the government regulators wanted to have banks in safe assets. Safe assets, the safest assets is either cash or treasuries. But there was a mismatch that happened. Like SVB had a significant amount of their money in longer term bonds, and interest rates have gone bananas. And because interest rates are like, we'll get into interest rates in a second, but because of that, it made their investments worth significantly less than they thought. So, and I'll stop there.
So, let's start with SVB. SVB is Silicon Valley Bank. And they're pretty well known as the #1 bank for the tech startup industry. And technology drives 1 in every 5 jobs in the country, whether it's direct employment or their supply chain, how they impact everything else. So technology is, we've talked about this a lot. It's incredibly important. It's why America is what it is. We innovate better than everyone else. That's why we're not China fast followers that just do it cheaper. We innovate and we can charge for that. So technology, in my opinion, drives the US economy. It really is why we're a leader.
I agree.
When we quit leading in technology, we will no longer be a global leader in the economy. We'll just be like everyone else. So SVB was the #1 technology banking business. And they partnered very closely with venture capitalism. They invested in companies. They're about a 40-year-old bank, Frankie. Started in the early 80s. And they've always been a big bank, but their deposits, because of 2020, what happened in 2020, we had COVID, and then we just the government flooded the market. They dropped interest rates. They flooded surplus into the market, surplus money supply. Cash came flooding in, and you've got some pretty interesting graphs that we talked about on this. But as they did that,
let me wait. I'm going to weigh in here. So what Ian's talking about, which I think is relevant, is this: going back to 1860, the supply of money was the highest it ever was after 2021. Right, ended the pandemic, 2020, 2021. It peaked at 26%. So that's the supply of money was 26%. To show you this, the next highest peak was 18% right when World War II ended. And the one before that was in 1880. So like this happens very, very rarely that we get over 20%. This means that people's checking accounts are fat. People have tons of extra money. Why? The government printed a ton. Unemployment quadrupled than what they would pay you. Nobody went anywhere. So they piled money into their savings account. House prices went up. So there's like $3 trillion worth of equity, things we talked about here before. Like here are all of the things that drove money supply bananas. Go ahead.
We gave everyone money. So we made interest rates cheaper, which drove housing prices up. You make interest rates cheap enough, people are borrowing to buy stocks, to buy crypto, to buy risk assets. And it worked. You know, the everything bubble, everything went up. So everyone felt richer, and everyone, you know, even when you sell, you have more capital. So a bank like SVB, they went from $50 billion of deposits to $200 billion, 4x'd, right? So because everyone was running to the technology sector when all this money flooded the system in 2020, and for good reasons. For a lot of it, you know, everyone was digital, right? Everyone started working from home. Technology was driving that, more and more people out of the office and in. So that meant the cloud business. That meant all of those businesses did make sense at the time. And when this happened, SVB had more money than it knew what to invest in. And all the venture capitalists were like this. They were getting flooded with money because the US government had created it out of thin air. And they didn't know there were no more tech startups to buy, to go invest in there. And so what happens? They start investing in dumb ideas, bad companies, bad startups, ones that didn't make a lot of sense. But SVB actually was the opposite of that. SVB just got flooded with money, and they wanted some yield, so they put it in long-term treasuries. And by putting it in long-term treasuries, Frankie, they were making like 1.5%, which is crazy because everyone's like, they were chasing yield. And it's like, you went bankrupt for 1.5%? Like, what are we talking about here? But they did. So they put all their money in treasuries, like to a crazy tune, Frankie. They had 94% uninsured deposit rate. So they have money in treasuries. So I'll try to explain this as simple as I can. Frankie, you go put $100,000 into SVB. You're a small business. You're banking there. That $100,000 is, you need it for lines of credit. You need it for other things. You're a small business. You have to have banking accounts to have credit, to be able to take out a loan, to be able to do a lot of different things. So you put money in there. They took your money without you knowing it. You're now an unsecured creditor of something else, and they put it in treasuries. And they put so much of it in treasuries to get yield with no thought of risk, no thought of duration risk. So what happens? Then 2021, 2022 happens. The government starts raising rates aggressively. And as they raise rates, what happens is other banks, to try to get depositors, they have to raise the rates that they'll pay on a deposit. And so, someone who was making 0.25% in a savings account could now go make 1.5 somewhere, 2% somewhere, 3% somewhere with an aggressive regional bank who wants to make money. When that happens, these depositors, Frank calls SVB and says, hey, can you match this? I'm getting 0.25%. Can you give me 2.5%? And SVB says, no, we can't match that. So Frank says, cool, send me my $100,000 back, which legally they have to give you that money back. They're a bank. They have to give you all of your money whenever. It's not a loan. It's not anything else. So Frank asks for his 100,000 back. And if enough Franks do that because they're being enticed to other places to take their deposits somewhere else, they don't have the cash. They're not, it's like George Bailey saying, well, it doesn't work that way. We don't have the cash. So Frank, if Frank was having a discussion, would say, well, where's your money? Well, I put it in treasuries. It's safe. Okay, cool. Then sell some treasuries. Well, the problem is our treasuries have lost 20% of their value. So now to go sell those treasuries, I'm selling at a loss. I don't have the cash to sell the treasuries either, because I will have to pay those bondholders just to sell the treasuries. And so now the CEO on the sly is trying to go out and raise money, because he's got to give the Franks of the world their money back, but he also has to sell some treasuries. And to do that, he has to lose money. And as soon as he started asking for money, everyone panicked and said, oh God, they're not solvent. And every Frank then called SVB and said, give me my money back. When everyone asked all at once, within 24 hours, SVB was being bailed out over the weekend by the government.
One of the real joys in doing this with Ian is I'm always compared to the person that causes the problem. I'm shocked George Bailey came up and I haven't already been called Potter. So typically, like wherever it is, there's a problem, right? So the other thing that happened,
Frankie, it is not your problem. Get out of here.
With the other thing that happened with SVB, I think Ian did a good job of summarizing that, but there's also something fundamentally that was a little bit different. SVB is Silicon Valley Bank. People from Silicon Valley, a bit arrogant. They also think tech is king. There's nothing that's going to ever rival them. Like they're imperative, right? So tech, the whole sector began to tumble after the Fed raised rates. So startups, they didn't have as much money to raise, so they had to use their accounts, and they drew down their accounts. And then as new investment money slowed down and people didn't put it in, this exacerbated the problem that Ian just talked about, because there's not new money coming in. There's just this money that they have on mismatched duration treasury bonds that they then needed to sell at a significant discount. So I think this is a perfect time to kind of talk about this, Ian. So in 1980, we're going to kind of go back a little bit, but in 1980, interest rates on a 2-year treasury in 1980 was 8.97%. So 9% interest. So houses and everything else were higher than that. That was the bank rate, 9%. 2-year treasury. It went from 8.9% to 16.9% in 18 months. So it less than doubled, but it had a huge percentage jump, right? In 18 months. Do you know what the percentage jump was between 2021 low on a 2-year treasury and the high in 2020, like today, at the end of 2022?
I don't.
So it went from 0.11% to 5.05%. So in the 80 to 82, it doubled. It went up 45x. So think about that on when you're talking about a treasury. a treasury trading at like 102, it's gone up 45 times. Like the jump in percentage was smaller, or excuse me, the jump in points was smaller, but the percentage is so big, it put all this undue stress on the system. And that's what caused what Ian just talked about with people like, I want to sell, but why the hell would I sell a bond that pays 2% when I can go get a new fresh issued bond that pays 4.7? So you have to sell at a huge discount, and that causes the huge gap in liquidity.
So what happens is the Franks of the world, the small business owners that had that $100,000, they're in a place where they can't get their money out. And if they can't get their money out, Frank's in a lot better place than a lot of these small tech companies, because they're not making profits yet. They're startups. This is the whole venture business. It takes 3 to 5, 6 years to get profitable and really build something great, right? It took Google 7, 8 years. Amazon wasn't making money for a decade. We talked about that in an episode.
Airbnb didn't make money for 9 years.
They don't make money, right? They're building something great, and they're reinvesting it in their business every chance they get. And so the Franks of the world are now in a place where they can't make payroll because they don't have enough cash coming in the door to make payroll on their own. They need to borrow to do that. And if they can't pull money from the bank that they thought they were banking from, they could be out of business within a week themselves. And so the government looked at this. It wasn't just a matter of depositors. It would be the ramifications of all of those small businesses missing payroll would impact so many more people than just the owners.
But I got to get into here, right? And I'll talk about this. So the FDIC limit was $100,000. And in the banking crisis, they moved it from $100,000 to $250,000. So for most normal human beings, $250,000 is a significant amount of money in a savings account, right? Like that's a lot of money. But for a business like mine, my payroll is more than $250 every 2 weeks. Like my check runs, my payroll, it's significantly more than that. So what happens is like I'm well capitalized and I've got more than 7 figures in the bank. But if you're only able to get 250 out, like everything screeches to a halt. So what the government had to do is they had to, like everybody in Silicon Valley, this is the funny thing, Ian, when you and I were in Vegas years ago, there was like a flash crash in the market, but we were drunk and not paying attention. And we're like, 2 days later, we're like, what the hell happened? When this happened, this was on the 10th, which was Friday. Was it the 10th? Is that right?
I don't know the exact.
Yeah, it was 10th. So it was 2 weeks ago. So it happened on the 10th. And when it happened, my wife and I got away for a day. We went away to Charlottesville, and like I was half drunk. I wasn't watching the news. I woke up on Saturday and like, what the hell just happened? But everybody was freaking out because like tech specifically, they're like, the government has to step in this weekend. And what the government did is they're going to wipe out. It's kind of like a bankruptcy with a company, which I learned the hard way. I owned a stock that went bankrupt, and I wasn't smart enough to sell it before it went bankrupt. And I looked one day and my stock was worth $0 because it went bankrupt. What they do is they take your investors and they take all the principal partners and they basically wipe them out. So that's what the government's going to end up doing. And then what they did is they stepped in, they made a loan, and then that loan allowed the bank to really not be closed at all. This happened on Friday. By Monday morning, they were back in business, but they're going to adjust the balance sheet so the government makes money on its investment. And that's what happened a lot during the last financial crisis. But they do that so these things, like you start missing payroll, it very quickly turns into something from one bank to a multitude of, that's been when there's a systemic run, which has to be avoided.
And the FDIC has not been around forever. It was created in 1933, and it was created after the Great Depression because there were so many runs on banks. That's when the $100,000 limit was created, and it's now been moved to $250. But now the question is, do they need to insure all deposits? They need to do, and I think it's worth us kind of just diving in a little bit and talking about the kind of the pros and cons of what the government is doing right now and why they felt like they had to do something. But I want to use a couple of quotes here because I'm in the middle a little bit on this, Frank. I'm a big capitalism guy. I believe that failure is a very big part of capitalism. Without failure, people will take stupid risks, and the failures can be even larger. So there has to be some fear that it won't work, or everyone would be doing it, and then you run out of money from a government. Charlie Munger has a great quote. Capitalism without failure is like religion without hell. I love that quote so much, but he also said, so I was interested in what Charlie and Warren would think about the bank bailout. Munger is on record just this past week saying this: I'd prefer to live in a world where nobody did anything undisciplined or stupid, but we don't live in that world. Therefore, decisions need to be made for the way the world is, not the way we'd like it to be. The government had no alternative but to back all of those deposits, or we would have had the biggest goddamn bunch of bank runs you ever saw. Which is, look, that's coming from a guy that I respect, who's a big capitalism guy. And he's also big on the idiots should fail and they should lose. But for him saying that, and now Charlie, this is also a guy who owns a lot of bank stocks and knows the CEOs directly of those companies. They called to ask him. So he's pretty close to it. And I would trust that if he thinks the government had to do something, the government probably did have to do something.
This is where I think he's right. Like, I think I'm doing everything right, but if my bank closed, like, what do you do? If 250 is the limit, you have to have like 14 bank accounts at 14 different banks, and then you got to wire money between different banks. Like, there's something there. For, like, the goal is to be successful and to have money and to have it in the bank because you're putting it back in the system and it's getting to work. Like, we know these things, but I think that's what he was saying, because the bad actors, I think there's something different in this, Ian, that I actually kind of like. I think the people at SVB made mistakes, and I don't know enough about the other banks. I've read a lot more about SVB than I have them. But during the financial crisis, like, almost no one went to jail, and no one was, there wasn't a lot of people who were like penalized. But in this instance, it feels like there's going to be there's going to be retribution. It's going to be financial, but it's going to be the people who ran the bank and ran it in a way that wasn't prudent. Like, I think you have an interesting perspective on this. And when we talked about it before, what you had said to me is they could have had a $60,000 a year, basically intern, monitoring their debt or their risk, and they would have been better. They would have been better positioned than they were. That's a major problem when a big bank, the 16th largest bank, is missing something that fundamental.
They didn't have a chief risk officer,
right?
Which is nuts. That's nuts. And what's
for a bank,
like, and not to make this political, but they were distracted. They had people on the board that owned wineries. They had someone on their risk committee that was like a winery owner. What does that person know about credit default swaps and insurance on mortgage securities? Like, so just without getting too wonky for our listeners, but if you own this many treasuries, it is this simple. If you own this many treasuries, all you have to do is run what if scenarios. So in business, there's something I love to do. It's called a pre-mortem. So it's a little exercise that you run with your teams. We should do this with your team. It's fun. You tell a team of executives, you say, it's 2026. We just finished up our bankruptcy. We went out of business. What happened? And you stop and you get to a whiteboard and you have them start thinking about what are the cataclysmic things that could happen that would take us out of business. And you start writing them on a board. We actually did this. I did this exercise at MBR with our top executives, with Paul in the room, and we had a consultant come in. It's called a pre-mortem. And it was really fun. It was, you kind of wrote it all down. We took bad land risks. We started building spec houses. We took out some bad debt. But in this case, it would have been really easy, Frank, because you had all like, in hindsight, everyone looks at it and you're like, you had all of that unprotected. You had nothing protected. You could have just brought in one guy from a consultant from another bank to look at your securities. All they had to do is say, what if rates went up? What if rates went up? What if they went up 1%? Would we be able to cover our deposits? What if they went up 2%? So when I say a $60,000 risk person could do it, I really believe that. In hindsight, it seems very simple. And so what you would do if you were a bank, Frank, is Do you know the term credit default swap? Is that too wonky?
No, I know it.
It's pretty much insurance. So you're buying insurance. A credit default swap says if A happens, I can put this back to the person I paid. So it's insurance on a security either going up or down. But if you're a bank, it's incredibly critical that if you're going to put that much risk into a long dated security, that you have insurance, which is a credit default swap. So you buy some X percentage. Now it's expensive. You're paying millions of dollars of premiums just in case that problem never happens. But God, you sleep better at night. It's like not having car insurance. It's like not having any kind of insurance. You should have some insurance for something like that happening. So you don't have to tell all of those small business owners, sorry, you can't make your payroll. We ran out of cash because we invested in treasuries.
This is the thing about this that I actually kind of like, right? What it's requiring is it's what's called a spread trade. It's a hedge. What you do is like as an example, like Ian and I like to gamble on football, and we're not very good at it, and we don't bet big sums of money. But like one of our favorite bets is a season bet because you put a couple $100 into it, and it lasts all season. It's a lot of fun. And I usually will pick like 6 or 7, 8 teams at the beginning of the year for the Super Bowl. And what I ended up doing is I had the Chiefs, but I did not think the Eagles were going to make it. But I was worried. Like, I'm like, okay, if I win, the Chiefs are going to pay me X, but I have nothing else happening here on the Eagles. What if the Eagles win? So I took the Eagles when they were favored. So basically they just had to, like,
you gave up some of your winnings to cover your initial bet.
That's right, just in case, because it's like it's senseless not to, and that's what and this is, I'm talking about a couple $100, in a FanDuel account, like a lot less serious than a bank. But I knew to do that because I was like, well, I don't want to lose all that upside, and that's what this banking is. But they're going to get, like, all the people on the board are going to get wiped out because that's what they had to do to keep the bank. They're going to move the bank forward.
There's going to be a lot of angst because you can see where this goes to a bad place, Frank. So
for sure, if it happens a bunch, it's really bad.
We were told in 2009 with Dodd-Frank that because of Dodd-Frank, American taxpayers would never have to backstop failing banks again. Remember, there were all kinds of problems with people were so damn upset about the fact that taxpayers had to get involved and they had to bankroll. And part of it back then is a lot of the guys that made those decisions were still in those companies, and the companies were allowed to stick around. So Lehman was the first one. Lehman and Bear Stearns were the first ones where the government was like, you're just failing. We're letting you go under because we're sick of letting these companies stand still. But now it's kind of becoming a permanent part of our culture that someone is always stepping in, and saving the day with these banks. And I think that promotes, the whole concept of it was to promote financial stability, and improve accountability, transparency, kind of ending too big to fail, which that was a political hot potato for sure in 2009 and 10, is we've got too many companies that are too big to fail, so we keep bailing them out. They said that about the autos. They said that about General Electric. They said that about AIG, the big insurance company. But by, trying to protect the American taxpayer by ending bailouts, they created this system where people almost took more risk. And it's just a trend. In 1998, long-term capital management, big hedge fund, went belly up, and the U.S. government jumped in because stock market dropped like 25%, almost in a couple of week period. So they jumped in and had like a $3.6 billion rescue. In 2001, after the tech bubble just collapsed, they slashed interest rates to reassure investors, especially tech stocks do better with lower rates. We poured $400 billion into troubled banks in 2008 and 9, and then we bought a 1.7 trillion in government securities. We've been keeping rates low. So it's this pattern 2020, we bought $1.5 trillion in treasuries to keep rates low and flood the system. And then the Biden administration came in and gave everyone a ton of stimulus. It got even crazier with money getting brought in. And so there's this concept that, that there's the moral hazard is the government will always backstop everything and you can take all the risk that you want to. And I think that poses a big risk, that if this concept of that's not capitalism. Capitalism is you take risks, you invest, and there could be a lot of profits for you, and you could also lose all of your money. But if there's always this put on the downside, people will take a ton more risk. And then the problem just spirals to bigger. And you see every one of these crises, Frankie, get bigger and bigger and bigger. And at some point, the US government's not going to be able to print enough money to fix the problem.
I think that's a big worry for a lot of people. Like the fact that money supply has dried up the way that it has is a very, very, very big deal. So I talked about this a minute ago with money supply being at over 26%. Money supply has gotten below zero 5 times, going back 150 years. So 1870, 1893, 1921, the Depression of 1929. The financial crisis of 2008, it didn't get below. It was at 5%, and unemployment still almost hit 11. So right now, money supply is negative 2%. So like these are things that are really big that are going to cause incredible strain on the system. And the government doesn't have a lot of ways to solve the problem. And I think that's what freaks people out is what are they going to do? And I don't know. Like, I think I've told you this. One of the guys that I work with as a corporate coach, he thinks there's going to be another, like he thinks 2029 is going to be really bad. Like a lot of people are already saying this one's going to be okay, but the next one's going to be critical or it's going to be terrible. But do you know when September 11th happened, do you know what Osama bin Laden's main goal was? Like, what's the reason he went after the towers?
Just to completely destabilize our system, our finding, because that's Wall Street is where, he wanted to just destabilize and create chaos in our markets.
He thought if there was basically an act of war, it would cause us to lose our financial footing and it could sink us. And I don't think he thought it was going to happen the way it happened. But I remember vividly, I think everybody who was alive does, right? Where were you when the space shuttle blew up in 1986? Where were you when September 11th happened, right? Like I was a 26-year-old kid. I didn't understand it completely, but I understand it better now. What the US government did is they stimulated the economy to create.
Where were you when Manti Te'o got catfished?
Oh, I remember that. I remember that too. It was at dinner when you and I were texting. It was a boring date. Also covered in previous episodes in the archives. But the point is this, the consumer confidence was immediately shaken September, 9 o'clock in the morning, September 11th. So 3 days later, the US government had slashed interest rates. And I remember being in a model home and interest rates had gone from like in the mid 7s to buy a house into like sub 5. And what happened was it created a huge run north. And that huge run, we should have had a recession right about then. We didn't. We had a stimulated economy for 7 more years. And then in 2008, instead of having a recession, we had a great recession. So what I think people kind of looked at with this, I think everyone got kind of fat and happy after we knew we were going to die from COVID, right? It did kill some people, but it didn't kill as many as people thought. People were home for a while. With all this money that pushed into the system, this is the backside of that. Like every up has a down. And if you push and you stimulate and you do all these things, like there's unintended consequences. And I think SVB is the first of many signs of what these unintended consequences look like. The fact that money supply has dropped as much as it has is a really critical thing. And it's something you have to be very, very, very mindful of.
I totally agree with that. I don't know about 2029 or anything else. What I do know is every time we've been told it's under control, this will be the last bank, this will be like banking crises happen. They don't all happen in one weekend and it goes away. Like something this big happening it's like a kingpin in bowling. If you hit the kingpin, it rattles around and knocks down lots of other pins. And it happens much slower. Like, investors would love it to be like bowling, where the bowling ball hits it in a split second, you see what fell and what didn't. In reality, sometimes these things take 6 months, 18 months, new things come out. When you look back at the financial crisis of 08, Frankie, you and I saw some very big signs something bad was coming in 06, as early 06. 05 a little bit, but 06 is when you started hearing about some rumblings in some of the banks, some of the loans started going away. So that took a few years to really play out. So everyone, Americans always just want the pain, like rip the Band-Aid off, let's move on, let's do nothing to see here. There's always more underneath this. Like, I think we're just seeing the tip of the iceberg on some of the stuff, but this whole concept so Frank did a good job of introducing this earlier in this episode. There's underwriting risk, which is I made loans to people that didn't qualify for them. I made bad bets on companies that didn't have good prospects of business. I made bad bets on people who couldn't afford a house as expensive as they were buying, that didn't have good job prospects, didn't have good credit history. That's underwriting risk. That was all the risk of 2008 and 9-10, was giving loans to people and companies that were not worthy of being lent to. Today's world, you're going to hear a lot about duration risk. Duration risk is I own some security and I have marked it to the market much higher than it's worth. Because there's a concept, Frankie, hold to maturity, right? And this is, again, it's wonky, but you're going to hear a lot about this pretty soon because the government's going to get involved in how they regulate. So hold to maturity is a security that you are holding for a long time. A security, it could be a 30-year security, a 5-year, a 10-year, and you can mark that to market on your balance sheet at above market prices.
So explain. So one of the things that happens with big banks, like the big ones that are regulated, that are too big to fail, they do what's called mark to market. But the smaller banks, the regional banks, aren't asked to be mark to market. I'm going to just tell you what I think it means, and you tell me if I'm right or wrong. Mark to market basically means you true up what it's worth and you resize your risk accordingly. So like, that's it, right? So like in a nutshell, what mark to market is this, is like, I bought an asset and I think it's worth $1. If it's worth $1.02, that's good. It's gone up to $1.02, so I can adjust my balance sheet. But if it's gone down to 98 cents, I need to adjust my balance sheet to the left because it's gotten less valuable. And these smaller banks don't look at mark to market because it's a lot of work and it's hard to do it. And it requires another level of management. And that to me is what I think is going to get regulated significantly.
Yeah. So, Frankie, let's take mark to market for a business like yours. You have, how many homes do you own right now? 300 homes?
Yeah, hundreds.
Okay. 300 homes. Safe to say those 300 homes are worth more if you were to sell them all in a fire sale today versus 2019?
Yes.
Okay. So let's say that's 20% more, maybe 30% more. But in that, let's say you've owned only those same 300 houses now versus 19. If you were to go get a loan tomorrow from a bank, would say that your assets were much higher than they were if you went in 2019. You would mark to market. You hadn't sold them. You've been holding them this whole time. But by going out and getting appraisals, comps, other things to show the bank, you could say, look, my assets under management are worth $30 million than they were 4 years ago. So I'm much less risky because I have so much equity. I could always sell these and make this much equity versus my debt. It makes your asset to debt number look much stronger, more powerful, and you can borrow more and you don't need to keep as much cash on the book. So here's the way banks do that. The government distinguishes between hold to maturity, which is any asset that you're saying is a long-term asset, and available for sale. So when I was an executive in a mortgage company for a home builder, all of our loans had to be called available for sale because we didn't service. So I would give you a loan, Frank, and I would service it for one payment. I would send you a bill and say, hey, you got to pay me the first month's payment. But my goal was always that we had to sell that loan within 30 days of you closing. So it was available for sale. The risk of available for sale is what if we did $100 million of closings and the market dried up overnight and we couldn't sell. Now NVR would have to come up with $100 million to go service those loans if something happened. And that could be a problem for the company. Whereas if we were servicing them, we would mark them very different. And so they played a game. They said, these are all hold to maturity. They're HTM. So they marked them up really high to make it look like their balance sheet was a lot stronger than it was. And the truth was those rates were going up, so that they were actually dropping, and they were able, their capital requirements for that, they were able to keep much less capital on their books because you don't have to keep capital for the hold to maturity stuff, which is nuts. And the reason is Dodd-Frank only looked at underwriting risk. It looked at risk-weighted capital, not equity-based capital, which is duration risk. Is that too wonky? But I'm trying to be as simple as I can about it.
No, it makes sense.
But you're going to hear more about duration risk now. That's going to be in the paper a lot. It's worth like kind of knowing a little bit about what that means. Banks are now going to be forced to say, if rates went up, are you protected? Do you have enough capital? Which means, so let's bring this down to simple terms, which means banks are going to have to keep more capital on their bank sheet. I think it's a good thing. But to do that, rates will go up to make profit. So rates are going to go up again for banks, and they're not going to be able to loan as much because they're having to keep more capital. So I think underwriting will get tighter because they have less money to lend out. And I think the cost of borrowing is going to get higher across the board because of these reasons, because now they can't play games with duration risk.
Makes perfect sense. So like, what does that mean in English, right? What do you do about this? We've been talking about, so I told Ian the story. I went and saw a bunch of speakers. I saw 22 different speakers, 8 of which were billionaires at the end of February. Ray Dalio in 2022 said cash is trash. In 2023, he said it's the best asset to have on hand. We talked a few weeks ago about our Berkshire Hathaway, the annual letter. And in that episode, we talked about is how much cash on hand Berkshire has. So households have cash. If you don't have it, try and get it aggressively. Like, these are things you need to do as a business. It's like stacking cash. Like, what we're doing is we're still in the process of selling things to continue to increase your cash hoards, because there will become a period in time where cash is going to really be valuable because the banks aren't going to just give it out, and it's a lot tighter. The other piece on the mark to market is this, and I kind of want to come back to this. I want your opinion on it too. So with mark to market, we don't get appraisals. We update our valuation of our properties quarterly. We do it every single quarter, and we send it out to banks. And we use kind of a desktop underwrite. So we will do appraisals at some point in time, but we're very active in buying. So we know if things are going up or things are going down. And typically what we do is we're 2 or 3 quarters behind the market. And the reason for that is, like, if you're getting an 8 or 9% surge, like, you don't want to count that, because it sets your mind incorrectly, in my opinion. It gives you a false sense of hope or a false sense of security that you shouldn't have. So, but it is critical. And even with a company as small as ours, we do look at our assets regularly and come up with what's the market value on these things, because we want to understand kind of where our footing is and where we are. What are your thoughts on that, Ian? Like, is that a prudent way to do it? Like, what are your thoughts?
The fact that you do it, I'm going to guess, and you're part of a bunch of masterminds. I'm going to guess the vast majority of the owners of in similar comparable size to you are not doing that on a frequent basis. They have more of a Pollyannish view of what things are worth, and they kind of spitball it. I think it's incredibly prudent. I've told you this before. I think Frank has a fractional CFO that he uses. He hires consultants to come in and look at his books, look at his finances in different ways. Frank does it. You're much smaller than the scope that we're talking about of some of these banks, but Frank, you're stress testing all the time. What if this happened? What if, like when I talked about pre-mortem, Frank does this all the time because it's his money. He's thinking about it. I think it's incredibly important that you're always trying to market and try to think, what if, or at least have someone on your staff, someone in your company who is a natural pessimist that thinks a little bit of what if, that especially if you're a more optimistic CEO or owner or company, you need someone always looking around the corner saying, but what if, because if not, you can find yourself a massive $200 billion bank that's out of business over a weekend.
One of the things I heard in the last couple of weeks is this: the person who worries probably shouldn't, and the person who doesn't worry probably should.
Yeah.
And the time to worry about these things is before it becomes a reality. And you have to be like, nobody's perfect. These things happen. But at the same time, if you're worried and looking at these things and you're talking and you're analyzing it and you're being honest, I think it gives you the highest likelihood to be ahead. The other thing we haven't said today that I think we need to is greed. I don't know if it played into SVB, but it does play into a lot of these things when there's problems. People get greedy. They're not prudent with what they save. And, you got all your chips on the table or all your eggs in one basket. And that's not always the best thing to do, especially if the market shifts.
So, it's when Frank and I say, focus on cash, build more cash, get your cash position. We're not saying run out and sell everything.
And we're not saying buy a bunch of 10-year treasuries.
Yeah, but we're not, sure, you should sell some. If you're 100% invested in stocks, not a great idea. If you're 100% invested in real estate, not a great idea. You should have a percentage of cash that can get you through 9 months, 12 months without a problem. You should think about worst case scenario. If I had to live without income, without revenue, how could I live? Do I have enough cash to do that? And if that means selling some things, then so be it. And if those things all go up and you gave away a little bit of profit, cool. You still sleep better at night. But I think, Frank, it's more than that. It's, if you run a business, look at every expense. Go try to reduce your expenses. Is your payroll too fat? Are you paying too much with contractors? When's the last time you've bid out your top 10 expenses? Have you bid it out? Have you looked at ways to save money? That's the same in your household. If you're not running a business in your household, go look at your credit cards. Where are the expenses? What's coming in? Do you still need it all? All of those subscriptions you have, what can you cut out? There are ways that you can reduce it that we weren't thinking about in 2020 and 2021 because money was so abundant that there were lots of luxuries. There are a lot of different ways you can generate cash. And then the other thing I'd say is, if you have variable income, work your ass off. Go take on a few extra jobs, do some extra work. If you're in sales, put in extra hours, bring in extra revenue and put it aside for that rainy day. There's, and if you're spending time on things that aren't making you money, stop doing it. Like, find lines of business that aren't working for you, quit doing it. If you've been bitching for the last 3 years that you are underpaid for your position and your skills in the market, all right, put your money where your mouth is. Go find a job somewhere else that pays what you think you're worth. Go get what you're worth. Now's the time to go get more revenue and to cut your expenses.
I agree. It's a wake-up call. There's another side of this that I think we can talk about, and kind of in closing. In Michael Lewis's book, it was called Flash Boys. Did you ever read that one?
Mm-mm.
So Flash Boys talks about like the traders that were like the momentum traders, the people.
Yeah, the guys that got faster and faster information with through cables.
Yeah, and I learned two incredible things in that book. Whenever anybody on Wall Street wants to learn what the competition is doing, they just interview people that work at different companies and ask them tons of questions. They never hire them. They just ask them questions about, like, what are you guys doing? How are you doing this? Like, I thought that was fascinating. Like, it's a great way to get information onto somebody, is like, you just interview them. Hey, we'll give you a job, and then you just get their info. That was one. But two, one of the things that Wall Street always relies on, and they're smarter than they're certainly smarter than me. What they always rely on is when regulation changes, there's new loopholes to look at. And what I'll say is this: like, I don't know if politics draws the best and the brightest. I tend to think it doesn't. And I also think it's really hard to govern. So What happened in 2008 and 9 caused a series of events, and they tried to prevent certain things from happening. But what happened was they closed many doors and windows, but something else opened. And with that opening, it caused the problem that we're seeing here. So you have to see, like, okay, this is going to happen. What are you paying attention to with what changes? When the regulations do change, what is now valuable that maybe wasn't before? Where do you have a bit of advantage now that maybe you didn't have before because the regulation has changed? Pay attention to what changes, and you might find yourself in a very fortuitous spot that you can capitalize on. But the only way you can capitalize on is if you don't drown. I talk about that all the time to companies. Like, we can't drown. Like, we're going to be great in 6 months as long as we don't run out of cash now. So it's like, you got to make sure you're going to live another day and then look for opportunity that's around the corner. That might be just because of regulation.
What I hope that comes out of all this, Frankie, I'm probably with Charlie. They had to jump in. They had to do something. I think you're probably in the same place.
I am.
But I think whenever this happens, inevitably the government overreaches, and then it becomes, well, we're going to backstop all deposits on all banks. And
right.
The problem with that, Frank, is if you take that to the extreme level, now you have a government-run banking industry. And I think that's incredibly risky for a lot of reasons, because I think lending standards and underwriting decisions now become politicized.
Yep.
You start lending to certain special interests who lobby more, or you lend based on trying to buy votes. And that's where your 2029 scenario comes in, right? If the government is influencing lending decisions because we're lending to people of certain special interest groups or whatever, but not thinking about capitalism, not thinking about the percentage of failures that could come out of those loans, what will end up happening is you'll have spectacular failures on these loans when something happens in the economy. And at some point, the US government's credibility will get crushed, and they won't be able to print enough money because people won't buy it. They'll be buying something else. It might be, Chinese currency, or someone else will step up as the more sane voice. Now, I don't think it's China, but at some point the US government could run out of credibility. And if that happens,
that's a big problem.
That's your event that probably starts a war. Like, that's a big event.
I mean, I don't know. This is where I usually get the comment, I'm not the best color man in the league for nothing. I think we talk this thing through. Like, there's risk. How do you protect yourself? How do you stay alive? When the mask comes down in the airplane, you put it on yourself first. Protect yourself first. That's most important. I saw something the other day.
Your bank deposits are safe.
Yeah.
You're likely fine where you're at. Protect yourself. Have enough cash. Build enough cash. Think about how you can generate more cash. Don't be fully vested, and don't listen to talking heads in the government that say this is contained. It's never contained when you have to say it's contained. Whenever someone has to say that, there's always more. So just don't be all risk on. Don't be all risk off. Don't run and pull all your money out. Be sane about this, but read, pay attention to what's happening, and have some balance right now. And I would also say have a lot of diversity of where your money is and what you invest in, where you have it.
I'm going to close with this. Control what you can control. Get great at what you can get great at. Shore up what you have inside of your control. Understand and manage your liabilities. Check your money. This is something that you and I just said a minute ago. Check your P&L. What are you spending? What are you not spending on?
Don't get into the ostrich effect, right? Don't stick your head in the sand.
And then go to work. Get great at you and at business. Those are the things that you can do to protect yourself. Like, that's it. It's that simple. Like, listen to a little bit, be aware, but focus internally on making sure that you are alive first, strong second. And if you do those two things, you can thrive, because you're not going to have worry and other things that are distracting others. You can press forward.
Good summary. One thing that I could do, Frank, as a starter, now that I'm giving all this great advice, I could maybe quit overpaying the government by $50,000 to $100,000 a year in taxes before I need to.
You're getting better.
I'm getting better though, Frank. Every year it's a little smaller than the year before when I send you how bad I am at it. Frankie, excellent episode.
Yeah, hopefully this was helpful for everybody. It's like, I'm looking at my desk. I've got like 5 different magazines, got news articles. I got all kinds of different things. It's like, you want to be as informed as you can be, but in the end, the things I said a second ago, protect yourself, do what's right, work hard, put your head down, control what you can, keep plugging ahead.
Finish where we started. No one knows anything. So be careful on who you listen to, including me and Frank, even though we're both incredibly, incredibly brilliant guys, clearly with our
not how brilliant we are, but we're certainly self-assured.
Incredible podcast. So if you are new to us, hit that subscribe button, mash it. And if you've been around for a while, get us with that 5-star review. We appreciate all of our wonderful subscribers. Be safe out there. See you, Frankie.
Good to see you.